Welcome everyone, and thank you for joining today. I am really excited because today we are diving into a very important aspect of trading that can make a huge difference in your analysis and decision making. We are talking about how to add and use the volume indicator in RTrader Pro. It may sound simple, but by the end of this walkthrough, you will have a better understanding of why volume is such a powerful tool. You will also learn how to customize it to fit your trading style and use it to identify opportunities that others may miss. So stick around because we have a lot of good stuff to cover today. Imagine you are trying to gauge the strength of a crowd cheering at a sports event. If you hear just a few scattered voices, it is hard to tell if the team has the full support of the audience. But when the entire stadium roars, you know that energy is real and powerful. The volume indicator in trading works much the same way. It tells you how many traders are behind a price move. Let us start with the basics. Why is the volume indicator so important? And why should we even bother using it? Volume shows the number of shares or contracts being traded over a set period of time. This gives you an idea of how active the market is and tells you whether price moves have the backing of a lot of traders or just a few. It is almost like reading the pulse of the market. It helps confirm whether a trend is strong or weak. For instance, if prices are going up but there is not much volume, that move may not last very long. On the other hand, if volume is high, then there is a better chance that the trend will continue. Knowing this can help you make better decisions, and that is what trading is all about. Now, let us take a closer look at some of the most significant chart patterns and how volume can enhance their interpretation. One of the most well-known chart patterns is the ** head and shoulders * pattern, which often signals a trend reversal. This pattern has a baseline with 3 peaks. The middle peak head is higher than the 2 side peaks shoulders. Volume analysis plays a crucial role here. During the formation of the head and the right shoulder, decreasing volume often indicates that buying interest is waning. The breakout, or when the price breaks below the neckline, should be accompanied by a significant increase in volume to confirm that sellers are stepping in forcefully and the reversal is likely to occur. Without this volume confirmation, the breakout may be weak and unreliable. Another highly significant pattern is the * double top, * or * double bottom * pattern. The double top pattern forms after an uptrend and is a signal that the price may start to decline. As the second peak forms, you want to see decreasing volume compared to the first peak, suggesting reduced buying enthusiasm. The confirmation of this pattern comes when the price breaks below the support level, and ideally, volume should spike to confirm that selling pressure is strong. In contrast, a * double bottom * forms after a downtrend, suggesting a potential reversal to the upside. As the price breaks above the resistance level formed by the 2 troughs, a volume increase can confirm that the bulls are taking over and the new uptrend is gaining strength. **, triangles * are also key patterns where volume analysis adds considerable value. ** ascending triangles * feature a horizontal resistance line with rising lows, indicating increasing buying pressure. Volume should ideally increase as the price moves closer to the resistance level, showing growing interest and the likelihood of a successful breakout. Conversely, ** descending triangles * feature a horizontal support level with declining highs, indicating increasing selling pressure. Volume should increase as the price moves towards the support level, suggesting that sellers are gaining strength. In symmetrical triangles volume typically decreases during the consolidation phase and then spikes at the breakout, regardless of direction. This volume spike is essential in confirming the validity of the breakout. Flag and pennant patterns are classic continuation patterns that often indicate a pause in the current trend before it resumes. During the formation of the flag or pennant, you generally see a decline in volume, which is natural as the market takes a breather. When the price finally breaks out of the pattern, you should observe a significant volume spike, which confirms that the market is ready to resume its prior trend. Without an increase in volume, the breakout may not have enough strength to continue in the direction of the trend. Wedges are similar in shape to triangles, but generally indicate reversals rather than continuations. A falling wedge often signals a bullish reversal, and you should see increasing volume as the price breaks above the wedge's resistance line, confirming the shift in trend. A rising wedge on the other hand, tends to be a bearish reversal pattern. Volume should decrease as the price moves higher within the wedge, showing weakening buying pressure, and a volume spike during the breakdown helps confirm the reversal. Rounding bottoms or cup and handle patterns are additional formations where volume analysis is crucial. In a rounding bottom, volume often decreases as the price moves down and begins to curve upward, showing reduced interest in the downtrend. As the price begins to rise again and completes the rounding shape, volume should pick up, confirming growing bullish sentiment. In the case of the cup and handle pattern, after the rounding bottom, the handle forms as a brief consolidation, and a breakout from the handle with increased volume is a strong bullish signal. Rectangles are continuation patterns where the price moves within a horizontal range bounded by parallel support and resistance levels. During the formation of a rectangle, volume tends to decrease, reflecting indecision in the market. The breakout, whether upward or downward, should be accompanied by a noticeable increase in volume to confirm that traders are committing to the new direction. By thoroughly understanding these chart patterns and how volume interacts with each of them, you can significantly improve your ability to predict market movements. Each pattern tells a story about the battle between buyers and sellers, and volume adds crucial context to that story. The more comfortable you get with combining these elements, the more confident you will be in making your trading decisions. Now, let us expand on the importance of recognizing chart patterns along with volume. Chart patterns like head and shoulders, double tops, double bottoms, and triangles can provide clear entry and exit signals. When combined with volume analysis, these patterns become much more reliable. For example, if you see a head and shoulders pattern forming and notice that volume is decreasing during each successive peak, it could indicate that buyers are losing strength and a reversal is likely. Similarly, during a double bottom pattern, if you see a significant increase in volume as the price breaks above the resistance level, it can confirm the breakout and suggest that the new trend is strong. Triangle patterns are another area where volume plays a crucial role. In ascending triangles, where the price makes higher lows and tests a horizontal resistance level, you want to see volume increasing as the price moves towards the breakout point. This rising volume indicates growing interest from buyers, increasing the likelihood that the breakout will be successful. In descending triangles, the opposite applies. You want to see volume increase as the price approaches the support level, indicating that sellers are gaining strength. Flag and pennant patterns are also highly useful when interpreted alongside volume. These are continuation patterns, and volume is key in determining whether the continuation will occur. During the formation of the flag or pennant, volume typically decreases, showing that the market is taking a breather. However, when the price breaks out of the flag or pennant, you should see a significant spike in volume. This volume increase confirms that the market is ready to continue in the direction of the prevailing trend. By combining chart patterns with volume analysis, you can significantly improve your trading accuracy. Volume acts as a confirming indicator, helping you determine whether a price pattern is likely to result in a strong move or a weak one. Recognizing these relationships can make all the difference between a successful trade and a false signal. All right, let us get into the details of adding the volume indicator in RTrader Pro. First things first, you need to have RTrader Pro open, and you want to make sure your chart is up. Once you have your chart ready, go to the top of the screen and find the toolbar. You will see an option called the indicator menu. Click on that and a search bar should pop up. Just type in the word volume and you will see the volume indicator listed there. Click on it and add it to your chart. You will notice that some bars appear at the bottom of your chart. These bars show you how much volume has been traded during each time period. Great job! You have just added the volume indicator. Now let us make it work for you. Adding an indicator is just the first step. Customizing it to fit your style is where the magic really starts. First off, let us talk about the colors. You want to set the volume bars to make them easier to read at a glance. Try using green for when the volume is up and red for when the volume is down. This way you can immediately see whether the buyers or the sellers are in control. If you think the volume bars are not easy enough to see, go ahead and make them thicker. This makes those big spikes in volume much more obvious and can help you react faster. You can also add a moving average line to the volume bars to help you see the overall trend. It can be especially helpful for spotting whether the volume is consistently increasing or decreasing over time. This simple tweak can make a world of difference when you are trying to make sense of market activity. Let us also dive deeper into using chart patterns effectively. One very common chart pattern is the head and shoulders pattern. This pattern often signals a trend reversal. You will notice a baseline with 3 peaks where the middle peak is the highest. When volume is decreasing as each successive peak forms, it often indicates that the trend is losing momentum. By using volume with this pattern, you can better anticipate the reversal, especially when you see increased volume as the price breaks below the neckline. Another useful pattern is the double top or double bottom. A double top forms after a sustained uptrend and indicates that the price may start to move lower. When combined with volume, you will want to see decreasing volume as the second top forms, and then a significant increase in volume as the price breaks below the support level. For double bottoms, look for increased volume as the price breaks above the resistance level to confirm a potential reversal. Triangles are also important, and they come in different types: ascending, descending, and symmetrical. In an ascending triangle, the price makes higher lows and tests a horizontal resistance level. Volume should be increasing as the price approaches the breakout point, as this indicates more buying interest. In a descending triangle, volume should pick up as the price approaches the support level, signaling that sellers are taking control. With a symmetrical triangle, volume typically decreases during the consolidation period and then spikes during the breakout, confirming the move. Flags and pennants are continuation patterns, and understanding volume dynamics is crucial here too. During the flag or pennant formation, volume should decrease, showing a temporary pause in the prevailing trend. Once the price breaks out of the flag or pennant, you want to see a spike in volume. This confirms that the market is ready to resume the prior trend. Without a volume spike, the breakout may not be reliable. Wedges are another useful chart pattern. Wedges can be either rising or falling, and they typically signal a reversal. A falling wedge can signal a bullish reversal, especially when accompanied by increasing volume as the price approaches the breakout point. In a rising wedge, decreasing volume suggests a weakening uptrend, and a volume spike during the breakdown confirms the reversal. By thoroughly understanding these chart patterns and how volume interacts with each of them, you can significantly improve your ability to predict market movements. Each pattern tells a story about the battle between buyers and sellers, and volume adds crucial context to that story. The more comfortable you get with combining these elements, the more confident you will be in making your trading decisions. Now that you have the volume indicator set up and customized, let us go over how to interpret it. Imagine that prices are going up and you notice that volume is also going up. This is a good sign that there is strong interest from other traders and that the trend may continue. But what if the price is rising and volume is shrinking? Well, that could be a warning sign that fewer traders are interested and that the trend may be losing steam. A sudden spike in volume can also mean that a breakout is happening. This means a lot of traders are backing the move, and it is likely to continue. Pay attention to these volume spikes, especially if the price is approaching an important level like support or resistance. If there is a lot of volume when the price is reversing, this may be a sign that the trend is changing direction. These are all clues that the market is giving you, and the volume indicator helps you pick up on them. Let us go over some trading scenarios where volume really comes into play. Let us say you are trading in a market that is trending. If you see that volume is rising as the price moves in your favor, this is a great confirmation that you are on the right side of the trade. For example, in an uptrend, increasing volume along with rising prices indicates strong buyer interest, suggesting that the trend is likely to continue. Conversely, if the price is increasing but volume is decreasing, it may be a sign that the uptrend is weakening and a reversal could be on the horizon. On the other hand, if you are looking for a reversal, you want to see the volume start to dry up as the price moves towards an important level. When volume decreases, it suggests that traders are becoming less interested, and a reversal may be coming soon. Then, if the price starts to turn and volume picks up, that could be your signal that a reversal is happening. For instance, during a downtrend, if the price approaches a key support level and volume dries up, followed by a sudden surge in volume as the price turns upwards, it can indicate a reversal and a buying opportunity. In the case of breakouts, volume is key. If the price breaks through a major resistance level and volume spikes, this is a strong sign that many traders are supporting the move, making it a much safer opportunity to take advantage of. High volume during a breakout confirms that the breakout is likely to be valid, as it shows strong market interest. However, a breakout without sufficient volume could be a false breakout, where the price fails to sustain the movement and returns to its previous range. Similarly, during a breakdown through a support level, rising volume is essential. If a price drops below a significant support level and is accompanied by a spike in volume, it indicates strong selling pressure and that the move downward is likely to continue. By carefully observing volume during breakouts and breakdowns, you can determine whether these movements have the backing needed to be sustained or if they are likely to fail. To make volume even more effective, let us talk about how to combine it with some other tools. Pairing the volume indicator with moving averages is a simple but powerful approach. For instance, if the price moves above a moving average and you see that volume is also increasing, this can be a strong signal that the price will continue to move higher. You can also use the Relative Strength Index, or RSI, to find out if a stock is overbought or oversold. If you notice that volume is spiking while the RSI is showing that something is oversold, this can be a great sign of a potential reversal. Another tool to consider is Bollinger Bands. If the price breaks through the bands and volume is spiking, this usually means something big is happening, and it is worth paying attention to. Combining these indicators with volume can give you more confidence in your decisions and help you avoid taking trades that do not have enough backing from the market. As helpful as the volume indicator is, there are some common mistakes that you want to avoid. The biggest mistake is to ignore volume completely. Price action is important, but volume gives you the context to know whether that price action is likely to continue or reverse. Another mistake is to trust a price move that happens on low volume. These moves are often weak and can reverse easily, so you always want to see strong volume behind important price moves. Finally, it is also a mistake to rely on volume alone without looking at anything else. Volume is important, but it works best when used with other indicators and tools that can give you a more complete picture of what is happening in the market. Let us also discuss some specific chart patterns where volume plays a crucial role in avoiding mistakes. For example, in the case of the head and shoulders pattern, it is easy to make the mistake of assuming that every head and shoulders formation will lead to a trend reversal. However, if volume does not decrease during the formation of each peak, or if volume does not pick up as the price breaks the neckline, then the pattern may be unreliable. Always confirm head and shoulders patterns with proper volume analysis to avoid false signals. Similarly, with double tops or double bottoms, a common error is to enter a trade too early without waiting for volume confirmation. For a double top, if the second peak forms without a noticeable decline in volume compared to the first peak, it could mean that the trend is still strong and the reversal may not happen. Likewise, for a double bottom, the breakout above resistance should be accompanied by an increase in volume to confirm the new trend. Without this volume, the breakout may be false and could lead to losses. When it comes to triangle patterns, one mistake traders often make is assuming that any breakout is reliable, regardless of volume. In ascending triangles, for instance, you should see increasing volume as the price approaches the resistance line. If the breakout happens on weak volume, it may not sustain, and the price could fall back into the pattern. In descending triangles, the same principle applies. Look for rising volume as the price approaches support. For symmetrical triangles, volume should decrease during the consolidation phase and then spike at the breakout. Ignoring these volume dynamics can lead to premature or false entries. With flag and pennant patterns, another common mistake is to assume that the continuation will occur just because the pattern has formed. During the consolidation within the flag or pennant, volume should decrease. If you do not see a sharp spike in volume as the price breaks out of the pattern, the continuation may be weak or may not occur at all. Volume acts as a confirmation tool that the market is ready to continue in the direction of the trend. Wedges, both rising and falling, are also susceptible to misinterpretation without proper volume analysis. A rising wedge usually signals a bearish reversal, but if volume does not decrease during the wedge formation, it might suggest that the buyers are still in control and the reversal might not happen. On the other hand, with a falling wedge, you want to see a volume increase as the price breaks out upwards to confirm the reversal. Skipping volume analysis in these scenarios can lead to mistaking a healthy pullback for a true reversal. By being thorough in your analysis and always considering volume alongside chart patterns, you can avoid many of the common pitfalls that traders fall into. Volume provides essential confirmation that helps differentiate between true breakouts, breakdowns, and false signals. This additional layer of analysis can dramatically improve your trading outcomes. Before we wrap up, let us talk about how the volume indicator can be adjusted for different markets. In the stock market, volume works well because every trade is recorded and you get a clear picture of how many shares are being bought and sold. In the foreign exchange market, however, volume works a little differently. Instead of showing how many contracts are traded, it shows how often prices are changing. This can still be useful, but you need to understand the difference. If you are trading intraday, you will want to use the volume indicator on shorter time frames like 1 minute or 5 minute charts to catch quick breakouts and reversals. Swing traders, on the other hand, should focus on longer time frames like daily or weekly charts to get a better understanding of the overall trends in volume. Now, let us recap what we have covered today. The volume indicator in RTrader Pro is an essential tool that helps you confirm trends, identify breakouts, and spot reversals. Adding it to your charts is easy, and by customizing it to match your trading style, you can make it even more effective. Remember, volume tells you if the broader market is backing a price move, and that information is invaluable. Use it along with other indicators like moving averages or RSI, and you will be able to make more informed trading decisions. Practice makes perfect, so take some time to get comfortable with the volume indicator and pay attention to how it interacts with price movements. Thanks for sticking with me through this walkthrough. I hope you now feel more confident in using the volume indicator to improve your trading accuracy. If you have questions or if anything was unclear, feel free to ask. I am here to help, and I would love to hear your thoughts on how you plan to use the volume indicator in your own trading. Keep practicing, stay focused, and remember that learning to read volume is a great way to get an edge in the market. Good luck and happy trading.